everyone. Thanks for joining. Today, we're fortunate enough to have a special guest, Rob Wessel from Hamilton ETFs. Been looking forward to this conversation for a while now. Robert is an expert on the Canadian financials, and we're going to get into a conversation today about what's happening within the Canadian market, specifically around the Canadian banks, some of the opportunities, some of the challenges, and Rob's overall outlook. So, Rob, thanks for joining us today.
Oh, no, thanks for the invitation.
Great. So for our guests, I was hoping you could give us a background into your history, how you started in your career, and where you are today.
Okay. Well, I'll give you the Coles Notes version since my career has been about 35 years. I've specialized in the Canadian banking sector, the financials generally, global financials generally, for over 30 years. First started out in corporate finance and was in investment banking for a period. But if my name sounds vaguely familiar to some of your clients, it might be because I was a Canadian bank analyst for 8 years. I was top ranked every single year, and then myself and our co-founder of the firm moved to the trading department. This was at National Bank Financial. Moved to the trading department for a couple of years, investing in financial services stocks before we started or founded the firm in around 2010. So been doing this for a while, and so I appreciate the invite.
Great, fantastic. So I know this is going to be a popular conversation because, as you know, there's a big home bias in Canada, right?
Yes,
A lot
for
of
sure.
Canadian investors, although the Canadian equity markets make up about 3% of the entire global equity
Hmm.
markets, approximately, many Canadians have almost 50% of their personal portfolios invested in Canada.
Hmm.
And I see this all the time. A lot of that makeup of their portfolios, especially do-it-yourself investors, is a high concentration in the Canadian banks, right?
Hmm.
So compared to the US market, the Canadian banks, the big six banks, super concentrated market. So
Hmm.
everyone knows the brands of these companies very well. So this is going to be a very interesting conversation for a lot of people. So start off with a pretty straightforward question. What's your thoughts on the current state of the Canadian financials? Anything in particular that stands out in the Canadian markets?
Yeah, so as it relates to the Canadian banks, I'd probably take a pass on the Canadian markets since I
Sure.
really only do the financials. But I mean, I have opinions, but they're not expert opinions. I think on the Canadian banks, there's a couple things to keep in mind. Right now, you have just come out of a somewhat turbulent period as it relates to macroeconomic risk. So you've had unemployment rising, you've had GDP growth that isn't terribly good. We obviously had an election. And over the last 2 years, what you've seen is the Canadian banks building loan losses. So building allowances, these allowance for credit losses on the balance sheet, building their balance sheet. They're also been expanding their capital levels. And part of that had to do with the fact that the macroeconomic environment had quite a bit of uncertainty. So loan losses or provisions for credit losses, which the banks record against bad loans, loans that have become impaired, what bankers call impaired. And those numbers and amounts have been building. And while I won't bore you with the accounting, there's a new accounting treatment that actually adds provisions for credit losses or credit costs against loans that are still performing. This is a new accounting treatment or since 2018. And so these two tracks or categories of loan loss provisions have been rising. So by Q4 of last year, we just finished Q3, it looked like they had peaked, and then this trade turbulence had hit with the so-called Liberation Day and the uncertainty around a relationship with the United States and an election, and you had what looked to be this year a credit recovery, or at least loan losses starting to fall, which would give you more capital and higher earnings growth, and is generally a very good period for bank stocks. Didn't really occur until Q3. So really, right now, there's two forces that are affecting the sector. One is, I mean, there's lots of things going on, but the two dominant ones that are fighting with each other, I guess, if you will, or maybe not fighting with each other, but are coinciding, is number one, there's no question that the market believes, if you look at valuations and you look at earnings growth, the market believes that loan losses are going to start to fall. That some of this trade stuff has kind of been worked out, or at least quantified, or people feel that they have a better handle on it. And so you saw in Q3, every Canadian bank but one beat. Stocks have done very well. And the second thing that's happening alongside that is price to earnings multiples, or the valuation that the market assigns to the Canadian banks, that dominant metric, has moved higher and higher. So yes, it would appear that loan losses are poised to fall, but it's also true that the market is pricing in some of that. So really, right now it looks like a very constructive environment if you believe that these trade tensions and these macroeconomic minefields, if they get satisfactorily resolved, then it's probably a pretty good period for them from an operational perspective. But they're not really pricing in any significant dislocation from our relationship with the U.S. And so that's the one thing I would keep in mind. Constructive environment. We'll see what happens with the budget and fiscal policy, but can't and regulation. Let's assume it's benign. And if loan losses can continue to fall, some of that's priced in, but there could be a reasonable amount behind that.
Okay. And when you say loan losses, are there any specific sectors of those loans that people are focusing on? Like, is it commercial loans for certain types of businesses? Is it within the mortgage book? What's an area of those loan loss that may be worrisome to the market?
Yeah, so I won't bore you too much, otherwise everybody will log off. But the first thing is it's not mortgages. Mortgages, because of our mortgage insurance program, tend to be losses on residential mortgages tend to be close to zero. It's usually corporate loans, auto loans, credit card loans, things like that. But no, there's no dominant category that would kind of stand out and say, here's the category that's leading the loan losses higher, and therefore its recovery. It's really more broad based.
It's more broad-based. Okay,
Yeah.
that's good to know. And what's a part of the Canadian market that the banks are trying? Is there any part that the Canadian banks are trying to innovate on, and how they're trying to improve their competitive edge over each other?
Well, I mean, the banks would say yes, I suppose. I would say there's nothing going on that is different than what you've seen over the past 25 years, which is to say, technology has continued to, reduce the cost per transaction. We all know that a bank branch used to have a deposit slip and things like that, and now you don't. You used to have to, you couldn't put your check in a bank machine. You had to go and talk to a teller. So all of that has played out, and the branches have been reconfigured. They're more advice driven and things like that. But no, I think those trends are generally slow moving. I mean, I know that some banks talk about AI and things like that. I think it's pretty early to be talking about whether that transforms the bank income statement.
Hmm.
So no, I think this 25 or 30-year trend that you've seen where technology has gradually improved the productivity and the service experience. Now, if you're 85 years old and you don't have a tablet, then your service experience has gotten worse. But
Hmm.
writ large, the service experience has gotten better for the average consumer. Obviously, not for retirees, I would say. But no, I don't think so. I wouldn't invest in the sector and think, wow, there's this. And I know you didn't ask about AI specifically, but I wouldn't invest in the sector because I thought there was some big transformational positive event on technology looming. I think it's still just a gradual trend.
It's a gradual trend.
Yeah,
Okay,
I think
so
so.
so for retail investors with average knowledge on the Canadian
Mhm.
financials, could you explain to them what's the biggest revenue generator for these institutions? Is there retail banking? Is it the capital markets division? Is it their credit business? What's the main focus for these banks?
Yeah, I mean, so I know we're going to talk about the differences between Canada and the US a little bit later, but
Sure.
generally speaking, what you have in Canada is a what they call a universal bank. So in the United States, which we'll talk about in a moment, they tend to be
Hmm.
just banks, with the exception of a few. But our banks, pretty much dominate everything, right? As we all know, they have their big mortgage books, their big auto loan books, their big credit card portfolios. They all have big mutual fund arms. They have full service brokerage platforms. And obviously they have huge investment banks. And the mix is different for each of the bank, but the biggest driver is almost always is in every instance Canadian retail banking, which encompasses all of the things that most of your people on the phone would recognize, which is you go into a branch, you have an auto loan, you have a mortgage, you have a credit card. That is the biggest driver of Canadian bank profitability, that lending business, which is aided or distributed through branches.
Okay. That's good to know. So you alluded to how we want to get into a bit of a discussion about the differences between the US banks and the Canadian banks. And could you give a broad-based overview on just to give investors an idea of how the financial systems are different, or
Yeah,
how there's a mix of the US banks aren't as fully integrated, and now
sure.
there's certain banks that have specific mandates of like
Yeah.
investment banking and retail banking, and how it's different from Canada?
Yeah, we could do a whole separate call on this, but
For sure.
I'll do the abridged version. So in the United States, well, in Canada, we'll go back to, and I'll just reiterate, the Canadian banks have a universal bank model, and historically, the financial sector, without getting too boring, has what were defined as four pillars: commercial banking, investment banking, mortgage lending, and insurance. The pillars, and they were always separate for most of history. And those pillars came down very early in Canada in the late 80s. So in the late 80s, they bought all the investment banks, which had full service brokers, and they built these mutual fund arms. And so fast forward to 2025, right now you have the banks are in every single business and they try to cross sell to each other. And those have made the banks, the Canadian banks, very, very, it, they've made them very durable companies because banks run into trouble when they have too much of something. When you look back in history, if you've had too much of something, whether it's LDC, lesser developed country loans, whether it's oil and gas loans, whether it's mortgage loans in the global financial crisis, if you have too much of something, that's when you can run into problems. The strength of the Canadian banks is, generally speaking, they don't have too much of anything because they're very diversified by revenue and by product and by geography. So, for example, if you look at the global financial crisis, where there was all kinds of problems that were creating credit problems, there was also massive fixed income trading revenues. So they had this massive stream of revenues coming in, which was helping support the underlying profitability on the other side, which is the bank side, which was deteriorating. So this makes the companies very profitable, but it also does lower the risk profile. Move over to the United States, because by legislative design and history, the sector is much more fragmented. Any one of your callers who's driven through the U.S., let's say you're in Toronto and you're driving to Florida, and you would see tons of different bank names that you would not recognize all the way along the trip. There would be, Joe's Bank, then there would be bigger banks that you'd heard of, then there'd be medium-sized banks that you might have heard of, and then you'd see JP Morgan or Chase, actually. And so, because that sector is still more fragmented, it has been consolidating and it's getting closer to Canada. But generally speaking, a US bank is more a bank. So, most of them, what they do is banking. You look at Key Corp, which Bank of Nova Scotia bought 15% of it. It's a bank. It takes deposits, it lends them out, and that's what it does. And then in the US, you would have you have three banks which would look like a Canadian bank, which is JP Morgan, B of A, and Citigroup, meaning they have retail banking and they have investment banking and wealth management. But that's three out of 5,000. Then you have, probably, then you have Wells Fargo, which is one big bank everywhere. And then you have what they call regional banks, which means they operate in a cluster of states. So maybe they operate in from like 5 to 30 states or something like that. Then you have mid-cap banks, which might operate in 3 states. And then you have smaller banks, which typically operate in one. So there's a lot of variety. So when you think about a U.S. bank and you buy it, it's generally speaking a bank. And what you care about is where it's doing business. Is it in Florida, where it's growing super fast? Or is it in Illinois, which isn't growing very fast? So geography is a very, very important dimension to U.S. bank investing, whereas in Canada, we're much more focused on just the overall economy and what's going on with the individual businesses.
Yeah.
I don't know if that was boring or too long, but
No, that was
that's the
perfect.
gist of it.
Because I think we've had conversations with some of our clients about U.S. regional banks as an investment theme over the past few years. And would you say that regional banks that focus on one or two states, their services or their lending
Mhm.
is catered to the needs of that area.
Yeah, absolutely. I think
So
there's a bit of a myth, I think, in I think Canadians, and I'm just generalizing, and by
yeah,
generalizing often means that, you're not capturing everybody's views. But I would say, generally speaking, the average Canadian investor doesn't believes that the quality difference between Canada and the US is greater than it is. Which, put differently, the US banks it's a much stronger system than it gets credit for by the average Canadian.
yeah, no,
It
I agree because
it's not a
um,
weak system at all. Sometimes you see people writing about US banking sector is very weak or whatever. That's not true at all. It is a very, very powerful, a huge, very powerful, very well capitalized, and in the main, a very good banking system.
and I agree. And I
Yeah.
think misconceptions that the Canadians have is if we date back to the financial crisis
Yeah,
of
that's
'08,
right.
you see some of these banks going under, Lehman Brothers, for example, right? But
Yeah.
I think people in Canada would just assume that a investment bank, they hear the word bank and they assume that the bank is just like the banking system in Canada, where it's a retail bank that went, if a retail bank went under, however,
Yeah.
that's not the case. So it's when we have conversations with clients, they do think that there's a much higher element of risk in the US
Oh,
banking sector.
100%. The big the big on the part that people don't that the average generalist might not appreciate is that in the United States they're not as big a mortgage lenders. So they have these big companies called Fannie and Freddie, and they house 50% of mortgages in the United States, and the fixed income markets have 25%. So only 25% of mortgages are held by US banks. So the global financial crisis, not to bore you too much with history, the epicenter of the problem was the mortgage lenders, not the
Hmm.
banks, which were separate. They weren't the same. Think back to in Canada when you had Royal Trust and Montreal Trust and National Trust. The analogy would be those companies ran into trouble while Royal Bank and CIBC and everything did much better. So it was the investment banks and the trusts, or sorry, the thrifts, which we would have called trusts way back when, that ran into the problems. That, don't get me wrong, the commercial banks had all kinds of problems, but the epicenter was over here, and I think that's where and almost all of them failed. So what's left standing was, banks that had held up okay, given the severity of the events. But yeah, I think that, right now, and then obviously the post-regulatory response has built all kinds of capital, and the sector has been very strictly regulated for a long time. So the idea that, the Canadians have a strong system and the US have a weak system is factually false.
Okay, very interesting. So just to build upon the Canadian banking and the US banking
Mhm.
differences, could you talk about how a lot of the Canadian banks now, or many of them, have a presence in the United States? And is there any differentials in operations between what the Canadian banks are offering in the US compared to what they're doing in Canada?
Yeah, I mean, this is a broad-based question because it's not the same for every bank.
Hmm.
But going very quickly, Bank of Montreal obviously is focused very much on commercial banking in the United States. They made the largest acquisition in Canadian bank history, Bank of the West, and they already had a sizable presence. So they're focused mostly on, we'll call them, they have a regional bank in the United States, albeit one that is all over the place. If you go to Bank of Nova Scotia, they have a passive interest in KeyCorp. So they're not operating in the United States, but they have economic exposure to it, and they have their own corporate loan book and so on. And then you go to CIBC, they have a small mid cap bank based in Chicago, and then National Bank does not have any operations in US banking. And then you move to RBC, which has a great platform, which is very diversified. They have the 10th largest investment bank. They have a large full service broker. Um, and they have this Bank of Hollywood, a bank in California that basically banks Hollywood. So a spectacularly wealthy client base, but very diversified. And they have a large full service broker. And then
Hmm.
if you go to TD, which everybody who has read the paper knows, they made one large bet in the United States, and some catastrophically bad risk management has put them
Yeah.
into the penalty box for the better part of the next 5 to 6 years.
Okay.
But
Yeah.
that's a very, very big, like they're the 10th largest bank in the United States.
Wow. So TD is a
Something
10th.
like that. Yeah,
Okay.
yeah, they're quite
Interesting.
large.
Yeah. And I believe Scotiabank's more focused on the South American and Caribbean markets.
Yeah, well, Latin America kind of writ large, but I think they seem to be focused now more on Mexico and the Caribbean outside of the United States. They do have a big corporate loan book in the United States, but generally speaking, if they're their platform is very distinct from the other. National and Scotia are the ones that don't have large U.S. banking operations. But as I mentioned, Scotia now has indirect or passive exposure in the form of a 15% investment in a very large regional based in Ohio called KeyCorp.
Okay, interesting. That's very insightful. So to wrap everything up on based on the great
Maybe
conversation.
actually, maybe sorry, I'll
Yeah.
so I don't leave people hanging. The idea here is they get diversified by geography, and the genesis of these strategies was that the American market is very large, the Canadian market is saturated, there's room for them to grow, and the U.S. economy is almost always better than the Canadian economy. So if you have U.S. banking exposure, in theory, the theory at the time was that you would have a higher growth profile
Okay.
because you have more exposure to a faster growing economy. And because the US system was still quite fragmented, there was room for the Canadian banks to build a platform, which turned out to be true, albeit with varying levels of success.
Okay, interesting. So given everything that we've talked about today, could you just give some of your thoughts on potentially the outlook for these banks, what sticks out, and maybe your thoughts on how could a retail investor invest in the Canadian banks and what would be an appropriate way to do so?
Yeah, so there's a couple things I would say is right now it's very hard to pick your own stocks because there's just so much going on with the individual Canadian banks. There's all sorts of idiosyncratic issues which are affecting the stock price performance of several banks, and those issues are unique to that bank. For example, TD Bank. They're in regulatory prison for a while in the United States, and that's the 10th largest bank in the U.S. or give or take that basically can't is not allowed to grow probably for 5 or 6 years. So what happens with TD Bank but they sold their interest in Schwab, so they have this huge capital. And so I guess what I'm saying is I think right now as I started at the beginning, it does look like loan losses are poised to fall. And that's a plus. It is possible also that some of these big allowances that they had built will get reversed, and that will also give them more capital and more earnings growth. It does feel like maybe the Canadian unemployment rate might fall because it's obviously not been falling, and that's a key economic metric. GDP growth in Canada has generally speaking been fairly mediocre. So to the extent that improves, that would be very important. So I think you have lots of reasons to be optimistic. The only thing I would say is picking the individual stocks right now is very difficult because the PE multiples that they trade at, that's the dominant metric. There's massive spreads or huge spreads between them, much wider than usual as these issues everybody's debating and nobody knows how to price it. So this does sound a bit self-interested, but we have been recommending that people maybe take more, and you're the advisor, so you know your clients and you talk to them and you know what their situations are. So I don't for a moment presume that my recommendation should supersede yours or because you know your clients and I don't. But there is a strong argument at the moment for just a simple equal weight strategy that is, you have everybody in equal weights. I normally, this is not always the best approach for everybody, but I think for now, given all of these wide valuation metrics, all of this uncertainty around some individual names and how the issues affecting them might play out, BMO and TD are good examples. That just a simple equal weight portfolio, and we do have one that has zero management fee up until February. It's called, the ticker is HEB, the Hamilton Canadian Bank Equal Weight Index ETF. We also have one that owns the Canadian banks as well as the Lifecos in Brookfield, which is our HFN, which is our financials. It also has zero management fee until February. For myself personally, my exposure to the Canadian banks, I actually own our Hamilton Enhanced Canadian Bank ETF, which is equal weight Canadian banks with very modest 25% leverage. Because I have a long-term time horizon. If you believe the stocks are going to go up, which I do, then I'm happy to not think about the individual names and just get the growth of the sector with a little bit higher yield and a little bit higher return, which should compound over time.
Mhm.
So my own personal portfolio, I have my exposure into the Canadian banks in our Hamilton Enhanced Canadian Bank ETF, which is the ticker HCAL, and I quite like that fund. I guess you would expect that I would say that.
Yeah.
But if you don't want a little bit of leverage, then we have the one below, which isn't. And so,
And for our viewers, can you just explain what you mean by leverage and
yeah.
what that
So
does
I
to
know
the
leverage
portfolio?
is a very scary term. So this is not like the 2 or 3 times levered ETFs, which are basically day trading vehicles. That's not this at all. Essentially, what happens is you invest $100 into HCAL, and then we go to any number of large Canadian banks and we borrow $25 in cash. So there's no
Okay.
derivatives or anything like that. We just borrow $25 in
Cash.
cash and we buy $125 of the portfolio. So you gave us 100, we buy 125. So you should get, roughly speaking, 1.25 times the returns and 1.25 times the yield net of financing costs. So because interest rates, we can borrow at institutional rates, which is lower than what, say, your average DIY investor could do on margin. We get a better rate, and it's tax deductible as well. Again, assuming you're in a taxable account.
Okay. No, that's
So it's
really
very simple
interesting.
and easy, and it's a small amount. I will also say that the risk profile of HCAL, which is the ticker, is not meaningfully different than an individual Canadian bank stock. So the volatility profile is not meaningfully different than one individual stock. So it's not you're not in my opinion not really it's not a significant amount, and it's enough to matter, but not enough to I think move you into a speculative category. But that's for you to discuss with your clients, knowing their individual situations.
Mhm. Fantastic. Rob, it's been super insightful today. It's a great perspective that I'm sure a lot of our clients and other viewers will benefit from. As we mentioned, the home bias in Canada is so strong. Almost 50% of people's portfolios can be allocated to the Canadian markets. And
Oh
for
yeah.
what I've seen as an advisor over the past decade is Canadian banks and financials make up a big portion of that allocation as well.
Yeah, and just to end that off, I guess the other challenge that a lot of investors have, particularly if they're retirees, is they might have owned these banks for such a long period of time that their cost base is so low that the capital gains taxes almost make it very, very difficult to
Yes.
to modify your portfolio. So your RSP is much easier than your regular portfolio. But there's no question that that's become self-reinforcing, and honestly, you know, that's why there's always such a wide audience for people like me to talk about the sector.
Awesome. All right. Well, Rob, we appreciate your time today. As I said, it was incredibly insightful,
Thank you
and
very much.
hoping we can reconnect in the future. Okay.
Absolutely. Thank you. Thank you again for the opportunity.